Hey everyone, and welcome back to the channel. Today we are going to know what happens when you invest $1 in stock. Let's get right into it. $1 is not a lot of money. It comes to only $365 per year, and almost anyone can invest $1 per day in the stock market. But what happens if you put $1 into stocks? Many brokers only sell stocks and exchange-traded funds in whole units. Depending on the company or fund, a single share could cost thousands of dollars. However, some financial institutions are changing their requirements. Investors can now buy fractional shares of individual stocks, and in some cases, ETFs for $1 or more through companies such as Charles Schwab, Robinhood, Square, SoFi, and Stash. The dollar is usually paid to the person or organization who sold the stock. You receive and now own a share, or a portion of a share, of stock in exchange. The mechanics of this exchange are typically handled by a stock brokerage firm or an investment firm. You request to purchase a share of stock, and the stockbroker locates a share for sale on the stock market and arranges for the exchange. In addition, your share is typically held in an account at a stockbroker or investment firm for you. Many years ago, they would send you a stock certificate proving that you owned a share of stock. However, this is no longer the norm. For example, your broker could purchase your stock from another investor or a mutual fund that was looking to sell some of that stock. If you hold that stock for a while and then sell it for $2, your share is transferred to the buyer and the money is returned to you. When a company first begins, it may issue stock to raise funds for expansion. In that case, the dollar is paid to the corporation that issued the stock. You're giving them money to grow in exchange for a stake in the company and future profits. However, the majority of stock sales and purchases occur after the initial issuance of stock. Unless the corporation that issued the stock chooses to issue additional shares, which they may do occasionally if they need money for further expansion, the money does not go to the corporation that issued the stock. Nonetheless, most businesses want their stock to rise in value. This shows that people are optimistic about the corporation's future. It also allows them to make more money in the future if they issue new shares of stock. A corporation will frequently reward some of its employees by giving them stock options. Now, can you get rich on $1 stock? As the numbers show, even if you start with $1, you can significantly increase your account balance over time. To get rich from $365 in annual investing, however, you'd have to start very early. Assume a child's parents began the $1 a day plan the year they were born, and the child took over as an adult, resulting in $1 saved every day for 65 years. That lucky person could have around $1.9 million at the end of that time. While that is a substantial sum, it is not as large as you may think after accounting for 65 years of inflation. However, if you plan to invest $1 a day, things can get complicated. It's certainly encouraging that investing is becoming more affordable for the average investor. However, if you're new to investing, you should stick to low-cost funds that track an index, such as the S&P 500, rather than picking and choosing individual companies to invest in. If you can afford fractional shares of a stock, you should probably avoid buying it in the first place. These funds have low fees and provide exposure to large swaths of the stock market, both of which are important factors in wealth accumulation. Stock picking is a losing game. No matter how much research you do, you're unlikely to outperform the market, and studies show that passively managed funds outperform actively managed funds. In today's world, most people are preoccupied with their careers, their families, and what time soccer practice is, and they simply do not have the time to monitor and research individual stocks. Leave it to mutual fund managers to make those decisions, or invest in an index fund to own the market. Both offer a lot of variety and low entry costs. Buying fractional shares of mutual funds has always been possible. It's essentially what investors do when purchasing funds through a 401k. The ability to buy fractional shares is now being extended to ETFs and stocks, which are typically purchased through a taxable brokerage account. Individual investors would benefit more from investing in mutual funds and exchange-traded funds. However, the allure of individual stocks is also present on some level. So is the belief that doing so allows the investor to outperform the market, which has proven untrue. However, if you're already contributing a healthy amount to a retirement investment account such as a 401k or IRA and want to dabble in individual stock trading, purchasing fractional shares can be a good place to start. You can invest in expensive companies like Amazon or Alphabet without spending nearly $2,000 on a single share. It's also a good way to try out a company before committing a large sum of money. After that, if it's part of your overall financial plan and you have the same time and resources, you can begin researching individual companies to invest in. That's it for today. If you guys enjoyed the video, make sure to hit that like button. Don't forget to subscribe and turn on that notification bell so you never miss out on any future content we'll produce for you guys. We're signing off now, but we'll be sure to catch you all in the next one.